Hello viewers. Now I think there's three things that made me a much better, more successful trader. The first one was using Renko. Second, adopting the samurai trading mindset. That's what I like to call it. And the third one is bringing in simple math into my trading, using it consistently, systematically, and that combination of the three took me up to the next level and beyond. And in this video I'm going to show you and talk to you all about that simple math part. It is really simple. You're probably doing it already, and if you apply it, like I said, it's going to give you an edge. And not a lot of people realize, but just adopting these simple math principles can take you from that losing 90% into that 10% winning bracket a whole lot easier. So with that, let's get into it. So trading, it's all about probability and expectancy. That's the math of winning systems, and not a lot of traders out there actually adopt and use these very simple basic principles. If they did, they would change their results quite significantly. Now trading, it's a game, like I said, of probabilities and not certainties. Every trade is a probabilistic event with a defined set of possible outcomes. Now the winning trader out there understands all that, the statistical edge behind their strategy, their system, and the outcomes that are likely to arise from that statistical edge, and they exploit them. Simple as that, repeatedly over time. And the focus of this video is all on the quantitative backbone of a winning trading system: probability, expectancy, risk of ruin. It's all the essential key math that separates gambling from professional trading. So it's a mindset shift that I'm looking for, an application shift. If you put in the effort, you will see your results change. Now the aim of the video is to make every trader think like a statistician, detached, systematic, focused on the long-term law of large numbers rather than individual trade outcomes. And like I said, you probably know the math already, you just don't know how to put it into practice. And that's what this video is about. Stuff you're using already, the win rate, the risk reward, the math that goes into that is pretty much what you need, and we can use that in different ways to, like I said, take our trading to the next level. So let's get into the detail. So first of all, we've got to get our head around the concept of probability, specifically in the world of trading. Now, probability is the likelihood of a specific outcome occurring, and in trading we know when we put that trade on, it's got two possibilities, either winning or losing. Now, in any system we define P win, there as you can see, probability of the winning trade, P loss, the probability of a losing trade, R, the average size of a winning trade, which is the reward, and L, the average size of a losing trade, which is loss. So they're key inputs into our calculations and our daily trading activity. And like I said, you use them already, or you should be using them. If you're not, it's probably why you're suffering poor results at the moment. So probability, let's get it into our heads, doesn't predict what will happen next. It describes what is more likely, the key word there, likely to happen over a large number of trades. And large number of trades also a key element, because a lot of people watch videos on YouTube where they say, I've done 10 trades, I've got a 90% win rate, I made this. That's not a very good strategy, because we don't know what it does over the longer term. So this is why professional traders think different. They think in terms of sample size and distribution and not individual short-term results. So with that thinking, we can then start drilling in to the key tools that we need to be using. So the first of these is called expectancy. It's your edge given to you on a plate, staring you in the face, so you know whether you should be trading or not. Now, expectancy is just a simple maths expression of your edge, the average amount you can expect to make per trade. There's the formula. All very easy because you already have those numbers. And as a quick example here, you've got a win rate of 60%, average win of 200, average loss of $100. Put it into the formula, you get $80 back. That means you've got a positive expectancy, and on average your system earns $80 per trade, but it's only as good as that information you put into it. So if you're tracking your results, you might have a back test, or you're keeping them going forward, going live, you know what to do. If you've got no expectancy, guess what? Don't trade. That's it. You know, it's giving you the edge, like I said, staring you in the face. And it's the mathematical truth of your strategy. It's not a feeling. It's not guesswork. It is cold, hard fact. Next up, and a critical concept to get into your head, is the law of large numbers. And this is what trips up a lot of people. They, like I said already, they look at stuff on YouTube. They've done 10 trades. It looks like a great strategy, high win rate, good P&L, means nothing, because 10 trades, we don't know in the long term whether that's good, bad. You know, it could be absolutely totally hopeless. And in the short term, results do fluctuate quite wildly, and that's what we got to be aware of. You know, even if you've got a positive expectancy, you've got to be aware that your trades could be going all over the place. So the law of large numbers ensures that over a sufficiently large number of trades, your actual results will converge towards your expected results. So in other words, consistency only appears over time. Randomness will dominate in the short term. So that is why bringing in, you know, tools such as back testing and forward testing really do matter. You know, we need to keep large samples to measure reliability, and you should be in your trading all the time, you know, monitoring your results so you know what the expectancy is. So the law of large numbers, really important to get into your head. And you'll say, well, what is a good sample size? Well, once you start to get to 100, it starts to improve, but ideally, you know, in terms of standard error, you're probably, you know, looking more towards 1,000 samples before that starts reducing. But we're going to keep it simple. We're just using simple math. So start with, you know, 100 trades and more. You know, your strategy might only be, you know, once or twice a week, and you haven't got a huge sample size, so you've got to factor that in as well, because maybe that's not the strategy. But if you're scalping, you're day trading, you're producing lots of results, algorithmic trading, you know, it's easier to produce a large number set. So also we're going to look at ways of measuring that through, you know, statistics like Sharpe, which will show us, you know, the consistency of variation a lot clearer. But first of all, concept, law of large numbers. Think about that when you're putting your trades and strategies and ideas together. So far we haven't used any, you know, complex maths, and we're going to keep it like that. The aim is to keep it as simple as possible, and that is what we're going to look at next. The components of a winning system are, you know, pretty simple. And what do we need? We need a win rate, we need the risk to reward ratio, and we need the sample size. That is it. And like I said, you've got those numbers already. They act in a non-linear way, and a low win rate can still be highly profitable if the reward to risk ratio is large enough, and vice versa. Now, this is a real important concept as well, and how I think all the time about my trading. So in system A, in the example there, we've got a win rate of 80%, a risk reward of 1-to-1, expectancy of plus 0.6, and we got system B only wins 40% of the time, but has a good risk return, 3-to-1, which gives us an expectancy of 0.8. You know, so that is, you know, a better system than the 80% win rate. But also when you're trading, you know, I run strategies that have a high win rate, 85-90%, but they have a low risk reward. But it works because I know I execute it consistently over the long term. I know my statistics. So when people are telling you, oh, you need a 3-to-1 risk reward, a 2-to-1, that is rubbish, because you can run winning systems with low risk rewards and high win rate, but you have to be managing those statistics all the time. If you don't manage them, you will lose, and you'll give away all your bankroll, all because you're not monitoring the win rate and the risk reward. That's all you have to do. Simple maths. Keep on top of that, and you can, like I said, create the components of a winning trading system. We're going to look at three ideas now: distribution, variance, and drawdowns. Now, firstly, distribution. Even a profitable trading system is going to experience losing streaks. So, for example, if your win rate is 60%, you're going to have sequences of possibly 4 or 5 more consecutive losses due to probability clustering. If you're aware of those, that's a good thing to start with, so because you've been keeping your stats, so it's going to help you psychologically. And the formula for that, again, very straightforward. It's just about plugging in numbers, and n there is the number of trades, as you can see in that first formula. With our example here, 60% win rate over 100 trades, that gives an answer of 5.3. So we could expect from our system to have 5 to 6 consecutive losses at some point. So you plan for it. Again, a simple bit of maths has given us a psychological tip, hint, help for us to, once we're in that, 3-4 losers, we're comfortable. We don't panic. Retail, losing traders will panic in that time and say, the system doesn't work, give up, move on to something else, lose their money. Whereas the pro trader goes, well, it's water off a duck's back. It's, 5 to 6 losses. I'm used to that. It's part of the plan. Let's move on. Variance. Well, variance measures how much individual trade outcomes deviate from the mean expectancy. So systems with high variance, big wins and big losses can have great long-term results, but suffer heavily in the short term with drawdowns. And again, that brings in a psychological impact. Can you wear, those drawdowns while you get to your longer term goal? So understanding variance helps set expectations and avoid system abandonment during drawdowns. Now, one way of measuring that is the Sharpe ratio. Again, we can simply put that together. It sounds complex, but it's not. We can put that together quite quickly, and that's going to help us, understand the variance. And we are going to look at the Sharpe ratio shortly. And drawdown, well, that's bleeding to death in trading terms. It's how much you're losing consistently, over time. We can measure that very, straightforwardly. And I'm going to show you an example later in the video how you can do that in a spreadsheet. But drawdowns are inevitable. It doesn't matter what trading system you're in. It doesn't win 100% of the time. So it's going to lose, and we're going to have drawdowns. So a trader, often the amateur trader, will quit during a system drawdown. So they're never going to realize expectancy over time. So measuring drawdowns either through back testing or, as it says down there at the bottom, Monte Carlo Simulation, becomes again psychologically very helpful for our trading. So if we know, of a given drawdown period that we might be in, and it measures into our back test or Monte Carlo Simulation, again, we stay with the system. We give it its chance to work. So as I see it, novice traders, they quit during the worst drawdown. Professional traders, they plan for it and continue execution. So the Kelly Criterion really is one of my favorite statistics. Sounds complex again, but it's not, because we've got the math to put straight into that formula. I'm going to show you an example in a minute. But once you've got a measurable edge, next question is, how much should you risk? And the Kelly Criterion is fantastic at coming up with a number for us. Obviously, a negative number, our expectancy, is, not worth even thinking about doing the trading, because what's the point? With a positive one, it's telling us how much of our bank account, our bankroll for our trading to put towards our trade, our strategy. There are many different methods of using this more appropriately in the world of trading. I've got a whole section in my book coming up on the screen now about how you could use that, but it is really straightforward. So, you know, if it's giving you, say, a 20% return on the Kelly number, use 20% on your trading. Like I said, it's not quite as straightforward as that, because you know, risking 20% on one trade is quite risky. So you factor in other variables. Some people use like a divided by 4 Kelly or divided by 8, or I use, for example, I factor in my losing streak number, divide that into it to come up with an answer. So want to get this concept across to you though, because A, it gives you the expectancy anyway of your strategy, and B, it lets you scale up. And this is a great formula. It's worked, in casinos around the world, in trading floors around the world. It's something you should adopt. So here's that example I promised you on the Kelly Criterion. It's quite simple. Win rate 60%, so P equals 0.6. Reward to risk ratio equals 1. We plug those numbers into the formula. It gives us 0.2. What does that mean? Well, 20% of capital of our pot, our trading fund, we should be using. That's the optimal risk for our strategy. But like I've already mentioned, professionals use something like half Kelly or less, or something like I use with a losing streak factored in to reduce volatility and psychological strain. So what does Kelly do? Well, it links probability, expectancy and risk. And it's giving us and showing us the mathematical edge and translates it into an optimal capital allocation. So like I said, a fabulous bit of kit to learn there. In a way similar to the Kelly Criterion, the risk of ruin, well, I use it in a slightly different way. I call it survival math. Even a system with a positive expectancy can fail if the risk that you're taking on is too large. So the probability of ruin, or the risk of ruin, calculates the odds of losing your entire capital before your edge plays out. And there's the formula for it. Again, don't worry, I'll show you an example of using it practically in a moment. But the key insight, the higher your expectancy, the lower your ruin of risk, and the smaller your risk per trade, the longer you survive. So really, we're factoring in trade sizing in here as well, in a reverse sort of way to the Kelly Criterion, because we're saying basically the smaller you risk, that obviously the longer your chances are survival. Well, we've got to balance that with our expectancy. So trading with negative expectancy or excessive risk guarantees ruin. It's not a question of if, it's going to be when. So the pros don't aim to win fast, they aim to stay in the game. Another mistake that the new trader makes. You want to make your money right now. You're already buying that Porsche. Don't. It's a long-term game. Think of the risk of ruin. So we've got an example here to show how it works. So we've got some basic numbers in there. We got the win rate 55%, the risk reward 1.5 to 1, so not looking too bad, because that gives us a positive expectancy of 0.375, and we've got a bank balance of $10,000 to our trading. So what does that mean in terms of probability of ruin over different risk per trade scenarios? So then let's have a look at changing our risk size per trade. So we've gone to 2% risk of our $10,000. So the number of losing trades to blow up, you're going to need 50. Pretty obvious. Risk of ruin is 0%, mathematically safe. And then we trade, we get a bit greedy. We want to go up to 5%. Well, number of losing trades to blow up, 20. That's a 1% risk of ruin. Sustainable but stressful. And then we go up through those examples there up to 20%. The risk of losing trades, 5, risk of ruin moves up to 80%. So guaranteed long-term ruin. So if you think of it in terms of that sort of idea, we get a bit more sophisticated by plugging in the numbers properly to the risk of ruin formula. You can get the exact risk of ruin percentages, but I just wanted to illustrate there. But by changing the trade size, the probabilities of the odds of you blowing up your account increase massively as you increase the risk per trade. Sounds obvious, but often ignored. So I'll just put that in the big bold there at the bottom of the slide. You don't blow up because you're unlucky. You blow up because your risk exceeded your edge. Remember that. Now, I like the Kelly formula, but I like this one even more. This encapsulates it all for me. And if you want a job in a hedge fund, they're going to ask you this question first. What is your Sharpe ratio? And the number you give them is the make or break whether you get the job or not after they've obviously done their due diligence. But it really is a fantastic ratio. It's going to help you in so many ways. Formula might look confusing, but again, it's not. I'm going to show you a simple way to calculate it. I'm going to go through an example, a proper example at the end of my own trading to show you, how you can easily put that together. But what is it doing? The Sharpe ratio is measuring how efficiently you earn that profit, how much return you make per unit of risk. And there you can see the inputs to the formula. And I've given you a simple way of doing it at the bottom, and as you can see, you've got those numbers again already. Average daily P&L divided by the standard deviation of the P&L times the square root of the trading days in the year. So 260, 250, whatever you want to put in there. So, but what do the actual outputs of the Sharpe ratio mean for us? So I think I can show this better visually with this chart here. We've got cumulative return versus time on the chart axes, and you can see the Sharpe ratio lines there, different scenarios. Now, what do you notice about the greater than 5 line? How smooth it is. That is just showing that basically you're printing money at that point. The deviation from the mean is hardly anything whatsoever. So that means your trading isn't experiencing drawdowns of any significance. You are hogging that line, and like I said, making money in the world of trading a lot easier. Whereas you drop to that 0.2 simulation down there at the bottom, you can see the P&L line is all over the place. That's because your strategy has big winners, big losers, and isn't as consistent over the longer term than, say, the greater than 5. So that one is a strategy. It works, it makes you money, but you've got to factor in that deviation, the measurement of that, into your trading. And that then brings in all the other statistics that we looked at, like drawdown, risk of ruin, all that sort of thing. So next slide, I'm going to just show you a quick summary of how you could think of the Sharpe ratio. So here you can see that if you've got a negative Sharpe, don't bother trading, your strategy is not working. 0 to 1, you're going to experience volatile P&L returns and large drawdowns, and gains will be slow to make. 1 to 2, pretty good. You can make a career from this strategy. 2 to 5, very, very good. You got that job at that hedge fund quite easily. Drawdowns won't be as big. P&L equity curve line, much smoother. And greater than 5, you're probably going to be an algorithmic or program trader, the ultimate strategy Sharpe result. You've got an out of this world, fantastic strategy. So there you go, some simple guidelines for using the Sharpe ratio. And just one other way of thinking about it before we move on, two traders can have identical expectancies, but the one with the lower variance and higher Sharpe is twice as efficient and more scalable. So who do you think the hedge fund, the investment bank, want to employ? Now, Monte Carlo Simulation is all about seeing the future. What is it? Well, granted, first of all, it is a bit more complex than some of the simple math that we've been using so far. in this video. But again, I'm going to show you in a minute an example I put together in a spreadsheet just to give you a flavor of how you can put something together pretty quickly to give you an extra tool in your arsenal. But Monte Carlo Simulation basically randomizes the sequence of your wins and losses thousands of times to generate possible futures. Now, the model you build around that can be as simple as or as complex as you need it to be, but the end result is it's going to show you the range of outcomes your system could realistically produce, from best case to absolute worst. It's not prediction, it's probability visualization. Again, another good psychological tool for your trading, because if you know the possible expected outcomes and you can measure yourself against them, then you're in a much better place. So by running Monte Carlo simulations, you can estimate worst case drawdown, quantify how often ruin could occur. You could see the full emotional volatility of real trading, and this turns back testing into realism. If you can survive the worst simulated outcome, you can survive the market. So let's have a quick look at that spreadsheet I mentioned. So my tip before we get into the Monte Carlo spreadsheet is to actually concentrate on the other statistics and tools we've looked at in this video first. This is taking it up a slight other notch, but you do need to know what it's for and how it works, because there are a lot of off-the-shelf tools that you can use, even in platforms like Ninja Trader, when you backtest, or MT5 or MT4. They offer these like Monte Carlo tools. So if you can use them without having to build the spreadsheet and you know what the results are, all the better again. But I've just thrown together this quick example just to illustrate the point of it's not too difficult to put together, even in Excel. Now at the top you'll probably get this in other demonstrations of Monte Carlo that you'll see. They're the random paths generated of whatever you're wanting to randomly generate over a period of time. Now I've got in that chart there at the top 250 different paths. Now Excel does struggle to build the number of paths I want, so I've limited it to 250 there, but demonstrated better, sort of summarized better in the percentile paths below the 5% up through to the 95%. And we've just taken call it a random stock, and we put the price there on the left, the y-axis, and we started at 100. That was the, say, call it the stock price today, and then we've created a simple model to predict where the range of the possible outcomes of prices could go from there. And you can see on there they range from 145, 150 nearly down to just under 80 for our example there. The nuts and bolts and all that, if we jump across to the inputs spreadsheet, that's all we put in to generate that. And obviously I haven't put the macro on the spreadsheet that just spins the simulations around 5,000 times, but we started with 100. We put in a drift rate, the volatility of the asset 20% annual, the horizon 1 year, the number of steps, that's daily 252, and the number of simulations 5,000. So when we're talking about our law of large numbers, by the time we get there the standard error is very low, and we're getting the results more towards the expected. And you don't need to know about random seeds at the moment, but that helps create the path of the simulation. But then I just quickly put the results inside here so you could see what they are. Don't need to know that, but basically that's what it's saying. It's giving us a range of outcomes over the next year for whatever you're looking at. So that is if you wanted, say, to predict a stock price. But how can that help us? Well, we can use that in simulating our strategy results as well. We can plug in variables to see what sort of returns we could get over a period of time, 3 months, 6 months, a year, longer. So it can be a really useful tool. And then once you go live, you can look back at the simulation and see where you are versus the simulation. It's a way of proving your model out. How many standard deviations are you away from the mean, for example. If it's negative, you might want to stop your trading and have a look what's going on, what's going wrong, reassess the model before going live again. So it is a really useful tool But like I said, concentrate on the other tools first and then move into the world of Monte Carlo. So let's start putting this, into some form of realism and practice, applying probability and expectancy to your trading strategies and systems. Here's how I think you should put it all into practice, or summarize. So we're going to define our entry exit risk rules, our strategy. We could backtest, for example, minimum 100 trades. It's a good starting point. Calculate your expectancy of it, confirm if it's positive, measure your Sharpe ratio, confirm efficiency. Once you get into Monte Carlo, you could test for robustness and then use Kelly or fixed fractional sizing for position management. Define acceptable drawdown and probability of ruin limits and execute your system without deviation. Consistency there truly is the key. Now I've got a couple of examples, just a quick one on a slide, and then we're going to dive into a funded account challenge that I recently passed, and I kept the stats on. I'll just show you how I keep track, utilizing these things that we've learned in the video today. So we've got a hypothetical Renko futures example here. The strategy on the S&P 500 ES mini futures contracts gives us a win rate of 55%. The average win is 10 points. The average loss is 6 points. That's $500 and $300. Plug them into the expectancy. That gives us $140 per trade. So positive, very good. If we trade 10 times per week, 10 for a whole year, that's $72,800 annual expectancy per contract. And that's even before compounding. So even modest edges in this example can add up exponentially over large sample sizes. So we now know that a winning trading system must have three simple mathematical conditions: a positive expectancy, the edge is greater than 0, controlled variance, drawdowns are tolerable and capital preserved, and repeatability, rules can be executed consistently without emotional deviation. Any of those three break, the system will fail regardless of how good it looks on paper. So we've just taken some simple math, nothing too spectacular, bunged it into a bunch of statistics and formulas and come out with a way of massively improving our trading psychology, our results, the whole shebang. Now I'm just going to quickly show you now a spreadsheet of results that I recently gained, like I said, on a funded futures challenge, just to give you an idea of how that could possibly look in practice. So I'm not going to tell you who the funded challenge was because I don't want to promote them, but I just wanted to show you how you could quickly put together stats to help you in your trading. Now, the Sharpe calculation that we talked about in great detail, and why I thought it was one of my favorite tools, all calculated here. How did I do it? Well, I just calculated average daily P&L, standard deviation of the P&L, and the square root of those divided by each other into 260 trading days. You can see the daily P&L was just put in there. Like if I just highlight that, you can see it just in there. Simple as that. And it came out over that period. Obviously, that's a very high Sharpe for that period. It's 20, which is fantastic. But whether that continued over a year, that's not expecting that at all. I'd expect that probably to fall down towards more, there are 3 mark, but still very good strategy. But again, it builds in expectancy to your own trading. Somewhere along the line there's going to be some sort of drawdown if you're going to get back to that lower Sharpe ratio. But also just keeping track of simple numbers like the cumulative P&L on the chart against you see the average going through there. Some value at risk, we haven't even talked about that one. That's another great one to test your trading on. And the drawdown, I've got the formula in here. You can see there was no drawdown whatsoever in that period. I've got a rolling drawdown going on here. Nothing there. And then what you do, I'll put these with the actual trades done during that time. I've got a win rate of 81%. Risk reward of 0.36%. Notice that that's under the 1-to-1. I'll mention that as well. You can run a very consistently good system if you are monitoring your statistics, and also building the Sharpe analysis against it. So I know I'm comfortable running this low risk reward with a high win ratio as long as I can maintain it, because the Sharpe there is producing money over the time consistently. And that gave me a Kelly number of 29%. So we did say that, you know, that would be your amount you use of your fund, and this challenge was 100,000, so I wouldn't use 100,000, you know, 29% of that. I work it out slightly different. I know, for example, how many losers I get in a row from that strategy, you know, and I've done a couple of scenarios there, and that's come out with my trade size. So basically I've got the Kellys, and then I divided it by those numbers to come up with either $750 or $375 a trade. I then go into a spreadsheet like sizing there, for example. You know, you can plug the numbers in down there as well on there if you wanted to. But then, for example, I want to trade the S&P, and I would then take what the Kelly size was. So if we say I took the higher 750 risk per trade, dollars per trade, and I had a stop of say 10 points, you know, that's going to tell me that I could trade 1.5 full futures contracts. Obviously can't do that, but I might want to go to the micro futures where I can trade 15 of them. So all of a sudden you've got a through system saving you time. It's systematic, you're consistent, you know, it's giving you all the tools that you need to make consistent profits over the long term. It's going to revolutionize your trading if you adopt these techniques. So what can you do next then? Straight into your world of trading, where you can take your current system or, you know, your discretionary trades, measure them, get those stats out there, find your win rate, average win, average loss, calculate your expectancy. You could run a simple Monte Carlo simulation in Excel or Python. You know, if your edge is real, refine it. If it's negative, fix it or abandon it. And from that moment, every decision becomes data driven, and that's how you move from trading on hope to trading on simple maths. And here is your trader's reality check. Well, trading success depends more on execution under probabilistic uncertainty than on prediction accuracy. The best traders, what do? Well, they accept randomness as normal, focus on expectancy, not single trade, size positions mathematically, not emotionally, and think in terms of distributions, not outcomes. So in probability terms, they're running positive expectancy algorithms repeatedly in a noisy environment, nothing more and nothing less. So I've just shown you that you don't need to win every trade, you just need to execute your strategy, your system, you know, your edge consistently every time. That's what you've got to focus on, your edge, and maintaining that edge. If you do, you're going to take your trading to a whole new level. So, you know, I hope you've enjoyed the video, you found it useful. If you have, please give us the thumbs up. It all helps the channel. And don't forget to hit the subscribe and bell notification buttons. Loads more content coming your way. And here on the TheStopHunter, we've got everything for you, really. I mentioned the Renko stuff, the samurai mindset, all the probabilistic thinking. It's all in the channel. Take a look, dive in. We've got loads of products around the world. You can see my books over my shoulder. I'll put links into the description below this video for those as well. So thanks for joining me, and I hope to see you in the next video.